Hey everybody, Preston Bryn here with our free weekly roundup brought to you by Trader User Group. Uh, Before I jump into the charts, just a quick summary of this past week. We've seen um, a number of instances of price action reverse course during the day and then during the week. In fact, at the beginning of the week, price action actually moved higher. We had 3 days in a row. And in the last couple of days, the market's pulled back, but we managed to finish the week up slightly. The Dow is up about 40 basis points, 0.4%. The S&P was up about 50 basis points, or 0.5%, and the Nasdaq was up a big whopping 60 basis points, or 0.6%. So the thing that I wanted to review here, though, is that the markets are still trying to search for direction. If you take a step back and you think about earnings per share, and interest rates, there is a correlation. Clearly, the price action is determined on a longer term basis based on earnings per share and interest rates. And when I say longer term basis, I don't mean day to day. Sometimes day to day it's a coin toss or a Trump tweet, which way the markets want to go. But longer term, they're going to seek the price where value is achieved for the amount of risk sustained in prices. So what we're looking at right now is a situation where we've got strong, very strong corporate earnings through Q1 so far. We've had about 20% of companies come through on earnings. In the next 2 weeks, we're going to get another 60% of the S&P 500 companies coming through. In fact, this week we've got some of the major technology companies reporting that we're going to be hitting the wires here, from Facebook to Google and Amazon we got coming up. But be that from that perspective, we've got very strong earnings. In fact, earnings are coming in a little bit over 18% year-over-year growth. It's going to be one of the strongest earnings periods we've had in quite some time, almost a decade. Strong earnings. This year, in fact, most analysts have raised their earnings projections. So that's provided some lift to markets and price action. But then by the same token, putting a lid on the upward momentum is interest rates. And anytime we get an upward movement in interest rates that's very quick, we had a spike in interest rates this week towards the middle of the week to the end, moving up, and we actually made 2018 new highs in interest rates. We hit 2.95, went up just slightly above that. And I'll show you the charts here in a minute. So rising interest rates, and remember those two things, earnings per share and interest rates, they're going to affect the overall level of prices. And then there's a number of geopolitical things that are floating on the horizon right now. So take your pick as to which one's going to drive prices higher or lower. We've had about 95, 96 days, I think, maybe slightly less. I don't know the exact number of days since we made our last all-time highs. And the last time we made all-time highs, I think it was in 2011 or 2012. It took, no, I'm sorry, maybe 2014. It took 157 days to take those highs out again. So, and while those statistics are fun to look at and argue over, right now, just looking at this chart, as you can see here, I've got a daily chart of the S&P 500 E-mini futures. You can see the 2018 open price in the middle of the chart there, and you can see we move back below into the red. We also move below the 50 EMA, which is this red line coming down here. You can see that we're well north of the 200 EMA, which is this yellow line here. And you can see we broke this upsloping trend line, which when I go to a tighter time frame, you'll see that we just clearly broke that out on Friday. I was hoping that we'd hold, but we didn't. In fact, I was hoping that the 2018 open price, it's kind of a psychological level. The markets just took that out. And then we closed towards the lower part of the trading range for the day. And you can see here, I've got these blue bars coming over on the left. This blue shaded area is volume over price. And we've got our next bigger support area right around the 2649 area. It is a 23% fib node from a wider time frame in the movement of the S&P. So this is going to serve as a near-term support for us. Okay. And you can see up above the resistance area, we hit it and we just could not get up above. You can see all the volume over price up here. That runs from 2730 roughly down to just slightly above the 2700 level, around 2708. But we gave it all up. And now we're back into the 2600, high 2600 area right now. And you can see the mass move here when I go from high to low was around 12.14%. So we moved 349 points roughly from the highs to the lows here. So that was put us in official correction territory. And if I step it out a little bit, just to give us a little bit of perspective here, and you can see the movement in the chart and the chart action here. Unless or until we can take out this key pivot point right up here, we're going to waste away in a larger consolidation zone. And then we've got a little minor irritant there and here, which is kind of down at this level right here, that the market's price action seems to indicate that it wants to retest this area. Now, I thought this retest here back in this area was a good one, and we had what we call in our group a poor man's bud right in this area here that suggested we should go long. But the minute we took out that upsloping trend line, told me that we got to just pull back, all bets are off, and let's see how this price action wants to go. You know, whether we come down and break this next support area here around the 2350 area, and then our 2650 area, and then we just come down and test the 200 EMA. Okay, sitting just slightly north of the 2600 area. So this is kind of what I'm watching for. The markets are still searching for direction. We've got good earnings coming out. I mean, they're very strong earnings, but the markets are expecting strong earnings. Analysts have been talking about it for months now. Analysts, in fact, at the beginning of January came in with an estimate for 2018 earnings around 16.5, 17%, or no, 12%. And then throughout the month of January, they kept increasing the earnings. And that's what we're seeing right now, okay? And we're seeing this movement up. If I take this down to a 2-hour chart, which is a good swing trade time frame, you can see this pullback and how we tested this upsloping trend line. And then we just walked the trend line up. And then we finally gave it up on Friday. And then as we moved forward throughout the day on Friday, it was just we moved all the way down and we closed down below the 2018 open price. So I'm going to be watching this very closely to see. Notice this wide shaded zone here is where we've got a lot of volume on the daily chart. So this is going to counteract some of this downward movement here, but we got to watch it really closely. In my mind, from a longer term perspective, if I take everything back, put it on the daily chart, and then just take some of this screen clutter off for you, like this. And you can see here that we did break out on Tuesday and Wednesday of this week. We broke out of this prior holding pin here, and then it was a false breakout because you can see I had measured a fib node that we entered into this big pullback here on March 21st. And then through most of April, we were staying underneath this. And we came down and we tested this low here. And then on this movement up, once we cleared the 200 EMA, I thought, okay, the 50 EMA would be a good challenge. And we took it out. We took out this trading range here. And then we just basically moved right back up, right? So we had this range right here. And if we looked at where the markets were closing, it was just a little bit tighter, right? And we just look at where the markets closed, right? These were the sticks on the candle, if you will. These were more intraday. But if you focus on where we closed, it was right in this area right here, okay? And then we busted up, and now we're going to come down and we're going to test this area right here. So that is the area that I'm going to be watching, this area here. If we bust a move and come back down into this area, we're going to be back into our chop again, and we're going to see the 200 EMA come back into focus as a potential support zone. If we bounce off of these lows and we move up, I'm not going to get long unless we take out the highs from last week. You can see all this volume over price right here. That would tell me that we've got a lot of resistance up in this range right up here, right around 27.20. Okay, but if we take it out, then I'm going to be a lot more bullish, and then the next area will be the prior pivot highs on this daily chart. So net, what I'm going to be watching for in the price action on the S&P 500 here is for prices to hold up right in this area right here. Okay, that will be my area that I want to see prices hold up, which is right around 2660. Okay, just in that area there. If we can hold this price, which was the lows made on Friday before we closed up off the lows. So if we can hold this area, give or take 3 or 4 points, right? And then we move back up, and then we take out these highs right here that were during the week around 2720 area, right? If we take that out, that will then become our support area, and then I will be more willing to go long. Until we do that, and we've got that decision point here at 2660, then we're going to be in a sideways chop. Earnings next week, we got technology. They're forecasted to come in around 22% year-over-year growth. Now, the forward guidance of the S&P, the PE ratio forward guidance, right now is sitting in the high 16s, low 17s. Earnings are expected to come in at 18% growth. Okay, so where the focus is on the forward projections of the earnings call. What are the companies saying? And you look and you see what the bank stocks did, right? If we look at, let's just put in XLF right here for a second, and you look at the bank sector. The sector came out, and we kicked off earnings on a couple of Fridays ago with JP Morgan and Citi and Wells Fargo, and then we had a lot of banks last week. All the banks have come in very good. They beat both top line and bottom line. So you may say, well, why is the XLF not going anywhere? Well, if you look at all the reasons for the beat with the bank stocks, most of them have been because of tax cuts and a few other things that tend to be temporary or ephemeral in nature, meaning they go away. And what the markets are looking for is longer term lasting solid growth. Now, higher interest rates should help that. A flattening yield curve hurts that. So the banks have this just like the markets themselves, they've got some things that want to power them higher and some things that want to power them lower. So we're stuck like the S&P in this overall range until it decides, hey, I want to break to the upside or I want to break to the downside. And we're just a Trump tweet away, or something else having to do with trade tariffs or other geopolitical things that could move us to the downside or to the upside. So what I'm suggesting, especially with our members, we got some trades on that we closed last week for profits. We entered a couple of new trades last week. We put a new one on that we're in nice profits already in the commodity sector. So there's some trades out there that are worthwhile, but you've got to be very careful and you've got to keep your position size down. We've done a couple of pre-earnings strangles that have worked out very well for us. And we don't hold these through earnings, but it's a gamma trade. We're going long delta or we want long gamma is essentially what we're looking for in these strategies that we're doing for our strangles. So anyway, this is kind of what I'm looking at here. Now, the other one that we took that I was encouraging all our members to go in on, because I just saw this as a great opportunity, was this one right here, which was the energy sector. So if we look at the energy sector, you can see here this huge move. I mean, we were in this tight range here, and we were in the range for quite some time. So it built up, a lot of momentum. And then when we broke to the upside, typically when you're in a channel like this for a while and you break up, you come down and you do a retest, and then you got that moment of truth in the retest. Where are we going to go? We're going to go back into the channel. We're going to climb higher. There was no retest about this. It just took off. Now, we happened to be positioned in XLE, so it turned out to be a nice trade for us. And I think energy is going to run into a big issue up in this area here. And obviously XLE surprisingly has not been that correlated to oil futures prices this year. XLE has been lagging, which is why I thought being long XLE made a lot more sense than being long oil futures. Okay, because if we look at oil futures, let me just swing down here a bit and then just get on the oil futures bit. Oil futures also took off and made new 2018 highs here on Thursday. And then we're just kind of in a sideways area here. I do believe, and we put on a new trade in the oil market as well. My target for oil was around 72. I don't see it getting much north of that at this point in time. Now, we do have geopolitical tension that could ramp up on May the 11th or 12th. Trump's got to make a decision. Are we in or are we out of the Iran deal? If we're out, that's going to push oil prices higher. The odds seem to it be 60-40, 60% shot that we get out of the deal, which is going to push oil up. If we stay in the deal, you're going to see oil come back in a little bit because there's a little bit of a risk premium in the oil markets right now. You've also got Saudi and Russia and a few of the other OPEC members talking about extending the oil production cuts. So there's a lot of geopolitical turmoil going on in the oil markets. I think oil at this price right here is a little bit higher than it should be. So that does reflect some of the fear premium that's going on in the oil market right now. Although we've got a trade on that's perfectly suited for this kind of market. We're going to just follow that along over the next 3 or 4 weeks here. So that's a little bit about what I'm seeing, kind of across the board. If we look at the Russell is outperforming everybody right now. Notice the Russell is above the 50 EMA. There's the red line. The Russell is in the green for the year. Okay. It's not that far away from its all-time highs. And you can see where the 200 EMA held up the Russell here. And then back in February, we went below, but we quickly closed and moved up above the 200 EMA. The Russell, being small cap and mid cap, is less affected by trade tariffs and other issues and gets a greater bang for its buck with tax cuts because most of the revenue from companies that make up the Russell are small cap and mid cap, which benefit greatly from the dynamics of political policy in just the U.S. only. But you can see the RUD is above the 50 EMA and in the green. If we look at Nasdaq, which was the strongest, okay, you'll see Nasdaq is again well above the opening price, but it's below the 50 EMA. So the Russell is the only index above the 50 EMA and in the green. But Nasdaq and Russell are the only two indexes in the green. And you can see the 200 EMA is providing firm support for Nasdaq as well as the Russell, as I showed you. If we look at the Dow futures, the Dow futures, we broke out of this upsloping trend line, but we're rolling over to do a retest. So this is where I'm looking to see if we can retest and move back higher. But again, we're below the 50 EMA in the Dow, and we're in the red for the year for the Dow. Same thing with the E-minis. If we look at the E-minis again, let's put everything back on the screen. You can see we're below the 50 EMA, and we're in the red again for the S&P 500. So the S&P 500 and the Dow were in the red for the year, and we're below the 50 EMA. For Nasdaq, we're below the 50 EMA, but we're in the green. For the Russell, we're above the 50 EMA, and we're in the green. So the Russell, on a performance chart perspective, is outperforming all of them. So when we've got this break, what I'm going to watch to see is if the Russell can hold the 50 EMA and stay in the green, and if the Nasdaq can regain the green. And we'll know that this week. We got some big technology earnings coming up, as I said. If that does that, it's going to keep these other markets, the Dow and the S&P, from falling too far. Okay. And if we look at volatility, let me get vol on here real quick here. If we look at vol, you can see here the VIX. We're staying in the yellow. I mean, we don't really get into the green zone. We're kind of staying in the yellow, and we kind of creeped up the last 3 days. We closed on Friday on the VIX at 1688. We actually moved up, into the 17s, but we came back in just a little bit. But we're still elevated, okay, very close to the front month vol futures. So we still got a little bit of fear out there. Okay. If we look at the bond market, sold off big time. This references as I said up in this area here, I wanted to be a seller in bonds up in this area here. Now there was another way that I recommended for our traders that we took this trade and our members. And those that did made some good money on the trade. My forecast near term for the bond market, as I've been showing here for the past couple of months, is down around the 141, 140 area, 140.30. And we're on our way down to take out the 2018 lows. Okay. So the bond market is clearly selling off. And it's like, remember what I said about 2 months ago, or at the end of Q1. Q1 was an very abnormal time for the markets. Equities finished in the red for Q1, but so did bonds. And that's only happened about 5 times in the past 5 decades. Or I'm sorry, in the past, I think 10 or 1 decade, where we've had 5 quarters where both the bonds and equities have fallen the same direction. So that is a sense that, bonds are not going to be as a flight to or safety as it's been before for big money. Okay. But you can see where it's gone here. And if we look at the 10-year interest rates, this is the result of that. We made, in fact, let me just put it on here because I was adjusting this during the day, and every time I do it, it just kept moving higher. So the 10-year, we actually moved up to 2.953. 295.3 is the way they say it. But so this is the 10-year rates right here, brand new highs. I'm calling for the rates to move up to about 303. All right, near term, probably by May, June timeframe, right in that area there. So there's some trades that our members are active in that can take advantage of a rising interest rate. Now, if we move slowly, then equities tend to be okay with it. But if you look going into Wednesday, the 10-year is at 283, and then we finished over the next 3 days up about 295. That's a huge move. You can see we actually gapped up, and it was kind of a runaway market in interest rates. And the last time that happened was the end of January, early February, and you guys remember what happened there with the markets. They just came tumbling down. Okay. If we look at the US dollar, all right, so the dollar also participated. I've been saying the dollar's been building a very long base right here. And the U.S. is the only country that's looking at raising rates and taking money out of the market. Now, the only reason why the dollar hasn't gone anywhere yet, it's perplexed a lot of people, is because global money is in search of yield and safe havens. And we've had our bonds and our interest rates stay artificially lower for longer than normal because all the other countries are still stimulating. South Korea, China, Japan, Great Britain, the ECB, the 19 countries that make it up, they're all still keeping their interest rates artificially low. So a lot of that money comes here to the U.S. and where does it go? It goes into the bond market. So it keeps the interest rates here relatively stable and lower than they should be. And then you throw on that all of the stimulus that the Trump administration is doing with the tax cuts and repatriation of money and the corporate environment, less regulation. Normally you see that stuff at the beginning to early stages of a bull market to really stimulate. Very rarely do you see it towards the end of a bull market cycle. And then we're getting this at the end of the cycle. So the Feds are going to have their work cut out for them over the next 3 years. This is why I've been saying for about a year now that we're going to move into a bear market in the next year to a year and a half. I'm extending that time frame only because at the time I made the forecast, we didn't have the tax cuts or the stimulus and all the stuff that Trump was doing. But now that he's doing this, I've kind of moved it out because it can always stimulate and move asset prices a little bit higher, goose them a little bit higher. But when the music stops, there's not going to be enough chairs for everybody to sit down, and the market's going to take a pretty good tumble. I think to the tune of more than 40% to the downside. And it's going to take probably 6 months to play itself out, 6 to 9 months to really turn into an ugly kind of thing. But not right now. I think near term, the markets are trying to pick a direction. And I think maybe near term we can still going to be in this chop until we have this breakout. So I don't want to panic you guys into saying, okay, now let's sell everything, right? I still think we have some more oomph to the upside, but it's not going to be pretty in another year. 2019 going into 2020 is kind of what my feeling is on this thing. And if we look at the British pound, because in the British pound, after the Brexit, everybody, I was a contrarian and I was getting our members, I said, we got to go long the British pound. And you can see this sell off here on the British pound. If we just kind of take it out, you can see right here with the Brexit, boom, we sold off and we were up that night trading things and just watching it come down. And then the British pound had the buds set up for us and everything started, and now it started moving up. And I said it's going to be a very choppy trade, but you want to be long the British pound. And this was back over here in 2017, January, February of 2017. Because in 2016, in July, I believe, is when they had the Brexit vote. Said you just cannot not be long the British pound. And you can see how this price is just, it's been very choppy. Every time we get north of the trend line or the channel, we come back into the channel. So we got north way up here overextended, we come back in. We got north, we came down up a little bit higher, but then boom, we're going to find ourselves back into the channel again. So I'd like to see the British pound come back down a little bit lower, and then I'd be more interested in dipping my toe in the water again. But we've been bullish this thing all through, and you could see the divergences setting up here nicely for a little bit more of a pullback. So longer term, I'm bullish the pound. Near term, this was Mark Carney when he came out this past week and said that he was more dovish than the markets were expecting. So I do believe that the pound near term could pull in a little bit before it starts making its run again. So that's kind of where we're sitting on that one. And gold, I love gold and silver longer term. Near term, we're not ready to break out yet. You can see here that the downside support is right around the 2018 open price. You can see this shaded zone down here, right around the 1300 psychological barrier. Up above, I left these up here just so that you can see the number of resistance points up north of us. We got the 2016, 2017, and 2018 high prices there, and that goes all the way back to 2016. So there is a ton of resistance up here. So we don't have the kind of market that's going to move gold through that. So anything up in this area here, selling calls out of the money makes a lot of sense to me. When we get down in this area down here, selling puts out of the money makes a lot of sense for me. When we're kind of in the middle, it's kind of like just stand aside and let's see which way it wants to go. Same thing with silver. Longer term silver, I am bullish. You can see we finally broke out of this area, but it could be like this area here where we broke out and came back in. I'm waiting for a retest. If we retest and then take off, I think silver is probably a better bullish play than gold. And I think silver over the next 2 years, certainly when we have our bear market, silver and gold is going to be up over 1,500. Silver is going to be up over in the low to mid 20s. So that's a good run. I don't think we're quite ready yet for the trade to trigger. Takes patience. If you want to get in early, you could probably sell some puts and get assigned and just build a position if you want to own stock in silver, something like that. Okay. And then I talked about oil. We look at the oil prices. It's one of those things where I do believe we're a little bit extended in oil here, but there is no I'm not getting any divergences here going all the way back to February. So every move higher has been supported by more volume, which is what you want to see in the futures market, right? There's a lot of volume in the commitment of traders, a lot of longs. But when you get too many longs, then the market is ripe for a pullback. So the pullback zone here on the daily is right in the 63, 64 area for oil. And then there's a wider support area down around 61. Okay, so I don't see, if we do move higher, it's going to be one of those, let's just flush out everybody. Everybody that's trying to get short now, let's flush them out, let's run up. Like I said, my target was around the 72 area, 71.50, 72. Not sure if we're going to get up there, but in this area here, I would not be interested in putting on longs. I'd be more interested in either playing neutral or slightly negatively skewed or biased oil prices back to the downside again. Nat gas, we haven't played in a while. And nat gas is just one of those trades where we've just got a ton of supply, just a ton of supply. In fact, they burn nat gas off as they get oil. They don't even keep some of it. It's too expensive to take it and transport it. There's a bottleneck in a lot of the Permian Basin because we just don't have the infrastructure to move all that stuff, right now. I'm sure we'll get there, but not right now. So I think nat gas has got a huge pressure lid over this thing. So every time it tries to build up pressure and move up, just can't get there. We had this huge move last year that was associated with the weather and the hurricanes and some of the things that were going on, but that was an anomaly. Okay. And then boom, we came right back down again, and now we're just centered right in this area here. So that's a little bit about where I'm looking at here. And gasoline, that was actually running ahead of oil, right? And if I move this up here like this, because we haven't been in the gasoline market in a while, but that's actually moved a little bit stronger than oil. But I think gasoline is starting to get a little bit over um, extended as well, the more of a downside. And then we've got some trades in the ag market that we're running right now. So things are looking okay for our members. We got a lot of, and we just closed, and like I said, a number of things down this week. We got some earnings plays that are coming up. So if you're not a member of our group, I highly encourage you to come in. We got an international audience. Also, we're well into our option masters, but for those of you that want to come in, I highly encourage you to do so. We've got a number of people that have signed up for it. A lot of strong interest in it. So it's certainly a way to learn more about trading, because we're covering everything, all the strategies. We even get into futures and commodities. We get into synthetics. We get into trade adjustments. We get into some of the exotics in the markets, as well as adjustments and things like that. So I think it's a pretty good value. Everybody have a great weekend. Members, I will see you this Sunday night for our weekly market watch. Take care, folks. Ciao.